Hello viewers, thank you for joining in. I'm Richa Agarwal from Equity Master and I've been looking at small cap space for almost 1.5 decades now. As some of you are already aware, I've been warning my subscribers of the lot of frenzy in the small cap space. The small cap to Sensex ratio is at all-time high. And amid all these warnings, I just came across this news that our group company Quantum is actually coming up with a new fund offer in the small cap space. So I'm very curious, why now, after all these years?
So if you go back in history in terms of, I guess your basic query is like, why are we launching in a peak market?
Right.
In my view, there's nothing like a peak market. In 2006 March, when we did the first NAV calculation and launched the Quantum Long-Term Value Fund, the index was at a peak then of about 6,000, roughly, the BSE 30 index. And between 6,000 and today, the index got up by more than 10 times. So was it a peak in hindsight? No, it wasn't. Because eventually there is an India growth story. And the Indian track record is such that as GDP is growing, stock market returns are growing more than the GDP growth rate. So by waiting in the future, we're actually not really we're not missing a peak. We'll be catching some other, what you may call, future peak.
Right.
And the other thing, of course, is when we receive the money, again, we're not asset gatherers, we're asset managers.
Right.
Our license says AMC, not AGC. So as an asset management company, our job, and really, I guess when you talk to Chirag about it, he'll tell you more, is to deploy capital in a sensible, cautious way. And that's what we'll be doing.
Right. So you believe in the long-term India story and all the pick and shovel plays in the small cap space that could actually capitalize on that. So my next question to you, Chirag, is that what kind of style do you suggest when it comes to small caps? Do you suggest an active style or passive style? And if you could share your reasons for that.
So if you look at the small cap space, like more than 85% of the listed companies are in the small cap space, right? And each story is generally a bottom story. It's not like large cap, you have a macro overlay and you kind of choose stocks of the sectors that you think will do well. But here, even if you get the sector right and if the company wrong, then you will not make returns on those companies. And why I say that is because in each company, you have to see the sustainability of the business model, whether the company has the ability to execute it, and how good the governance is. Can you trust the founders, promoters, managements of those companies or not? That is a very important trait of the small cap world. And therefore, I think active works better. And even in the small cap world, when you spoke about the valuations, there'll always be pockets where there will be some sensible valuation prevailing and the growth opportunity to capitalize on that valuation that prevails. So overall, given the large universe, given the certain traits that you need to look at in the small cap world, I think active is the way to go about it.
Right. So the thing is that, when people look for active investing, they are likely to look for, people who have some kind of expertise or track record. Now in a bull market, the luck can get masked as skill, and there are a lot of people who are showing good returns. And this is an age of influencers where everybody's being a small cap expert. So how do you suggest one should go about when it comes to selecting the advisor, or how should one go about selecting a fund for small cap?
So one of the key things, I think, of course, is the sort of, you step backwards and ask what is the allocation that an investor should have to a small cap fund. So if you go on the Quantum website, you'll actually see this triangle where we recommend at the base of that triangle, you have your safest asset class. And then as you go up the triangle, you're taking more risk. And as you take more risk, again, that's investment 101, more risk you take, the more return you should expect and you should get.
Right.
So small cap funds are somewhere at the top of that triangle. They're not at the base. And as you go up that triangle, the space and area is a bit smaller than at the base. So probably 5-10% of your portfolio at the very max should be in the small cap space. I know that Equity Master, and you've been doing research on small caps for a long time. And I think that is your allocation that you suggest to most of your viewers and subscribers on that. So in a very similar way, we also believe investors should not have too much money in small cap. They should. It's an exciting space. Now the question that you asked is, how do you select the fund? So it's a fascinating question. I can spend hours on it. When we meet with institutional investors, they look at a track record, look at a history, and they try to understand what they call portfolio attribution. So which stock or what kind of stocks gave you the return that you claim to have or reported to have over different cycles. in a bull market, in a bear market, over the last decade, over the last 5 years, etc., etc. And from that, they get portfolio characteristics. And from that, they can understand whether the manager is shooting from the hip or whether they have a proper process in place to actually allocate the money that you've invested in a small cap fund in a sensible way into small cap universe of stocks. And in the attribution analysis, when all these institutions do it, let's say you start with 5,000 crores of AUM in a small cap fund and you built a certain track record. And let's say your top 10% of the portfolio in that 5,000 crore fund is maybe 40%. Now, what happens if you collect more money? Chances are, because these are small caps and a lot less liquid than the large caps, as Chirag indicated, you will not be able to replicate the portfolio on which you as an investor made the investment. Right? So you bought something thinking it's an apple and you may end up getting a banana. Right? Because the characteristics of the portfolio will change because of this excess asset gathering mode that much of the industry is in. So the first thing that I would caution an investor is try to understand what is the characteristic of that fund, not only the past track record. I was at a conference yesterday after a long time, and one of the people on the dais made this very laughable statement, if I can put it that. He said, oh, when we look at our database and we try to see how investors on our database, how they performed, they all bought 5-star funds and they all underperformed the Nifty index. And I was in the audience, I was laughing at myself saying, yeah, because you're looking at backward data, you're taking a 5-star fund and much of the ratings are based upon historical data, not on characteristics. So you've taken a fund which has probably hit its peak and you've invested in it. And what happens to the fund is its style goes out of favor, the environment changes, or the fund itself has too much money and cannot replicate that track record which you bought. And then it becomes a 3-star fund. And now you've underperformed the Nifty index. So tracking the star rating is dangerous. I wish SEBI would make it a law, and they've got many such laws. They should make it a law that every fund should declare its capacity. So when you go to buy a BMW, or an Audi or a Mercedes or any car, and if they're going to make 1 million cars in a year, you don't ask BMW if the car that you bought was a 300th car or the 10,000th car or the 50,000 car, because the quality is the same. Yet in portfolio management, in fund investment, you need to ask your fund manager, because when you bought that fund and it was 5,000 crores track record, and a lot of people put money into it, becomes a 20,000 crore small cap fund or a 30,000 small cap fund, it suddenly goes from 90 shares held in the portfolio to nearly 200 shares in the portfolio. You thought you're buying the apple, you got the banana. And a lot of slippages in that. So investors must, of course, look at track record, must look at pedigree of the fund manager and the fund management house. But these sort of things that I've told you is not available to most investors, and SEBI should, in my view, make these forcible disclosures from their perspective. So long answer to your question, it's not easy, but you have to obviously understand the process behind every fund management team which is out there offering a fund.
Yeah, I appreciate that long answer. It gives you a lot of insights. But until the regulator comes up with these disclosures, now that you're launching a fund, Chirag, would you like to talk about the traits of this fund and what differentiates it from the other small cap?
Sure, absolutely. So we have seen the problems with portfolio construction in the small cap space. As the size has grown, the number of stocks in those portfolios have grown, as Ajit alluded to. So overall, what was a sizable bet in that fund has now become a very small or suboptimal position in that fund. So given that one is suboptimal position will not yield you better returns, of what you expected or what you have seen before will get diluted going forward. That is one thing. Second is liquidity risk. Even though they have smaller positions, the liquidity does not exist at that size in those stocks. So when you are trying to buy, you may be able to buy, but when you try to sell, you will find it very, very difficult. We have seen liquidity in terms of 3 months is acceptable liquidity to get in or get out of a fund, of a stock. When it exceeds that, it becomes a risky proposition. And we have seen that many stocks will take, in those funds, will take 500, 600, 1,000 days to exit out of those positions. So, so one is have a NAV and one is to have a transactable NAV. So you have an NAV, but it's not realizable in true sense, because when you go to sell, there is no liquidity, and there is no liquidity, the prices will fall when you try to sell.
Right.
So that's a problem that we face in the small cap space today. And given that, even though they have small positions like, 0.5%, 0.6%, they're like 8-9% of the company. So they will not be able to exceed beyond 10%, and 10% is at the mutual fund level.
Right.
So they might have holdings in other funds as well on those stocks. So overall, even if they have high conviction on those stocks, they will remain suboptimal positions at 0.5%, 0.6%, because they don't have headroom, because they are already 8-9% of the company.
Yeah.
So those are the issues that we see in the small cap world, and that is how we have designed to overcome those challenges. So we have a well-defined framework for our universe. We'll have a minimum liquidity of 2 crores trading per day, so that we can scale up the fund. Like you invest the first rupee in the fund, to or even the 5,000 crore rupee will be invested in the same way, giving the same portfolio characteristics. So liquidity will be essential trait. We will not exceed more than 5% of the market cap of the company. So those are well-defined metrics that we have in place through which we will build the portfolio. And we will have a minimum position of 2%. We don't want those small suboptimal positions. Our research should speak about our conviction on those stocks, the study that we have done on those stocks. And that is why minimum 2% weight will be on each stock, and maximum 4% to control that risk. So overall, well-defined metrics on liquidity, market cap, and positioning in the fund, which we don't see, or we see a compromise in many of the funds outside. And also, we want to be true to mandate, not deviate too much. There should be some liquidity requirement. We could be in the large and mid-cap space to some extent, but majority of the portfolio will be small cap. And we want to be true to label and not deviate too much in the large and mid-cap space. So this is how we'll address the challenges, and this is how we'll build a portfolio.
Right. That's an interesting thing about the process. Could you also talk about the philosophy, or how you're going to select, the candidates that make the cut? Something about.
Sure. So as I said, liquidity and market cap are very important considerations for us when we look at these companies. Governance, again, is non-negotiable for us. Any company we find not good governance, not good any things that we identify which are red flags, we will not touch those stocks. So which is very, very important in the small cap world. Third is we will buy growth opportunities, but at reasonable valuations. So that, it's a GARP approach, but we will be mindful of valuation, not mindlessly chase those growth opportunities that exist there. Because if there is no upside, there is no point buying those stocks. So these are the very three important, and we are buying for a long term. If we see upside potential, the compounding in those businesses, we will continue to hold those businesses for the long run. So this is how we will kind of define, and we will build from a qualitative perspective the fund trades.
Right. So, but coming back to the challenges within the small cap space, considering where the valuations are, I know that in the long term we are all positive on Indian economy, and we expect all small cap companies also to do well. But right now, how do you plan to address that challenge when it comes to expensive valuation?
Let me take that. When we did the launch of the Quantum Long-Term Value Fund in 2006, as I indicated, markets were then at the peak at that point in time. And we sat on cash. So SEBI gives you 6 months to deploy the entire cap. That was the rule then, to deploy the entire capital. So at least 65% has to be in stocks. We were not 65% from day one. We were 0% stocks and 100% cash. So from March till June, we slowly deployed our capital. And at that period of time, we looked like idiots, because you're holding cash and markets are hitting new peaks, and cash earns you nothing, and stock markets are rising 2% a week or 2% a day, and you look like a fool. Markets corrected at that point in time in June, July of 2006. Once they corrected, we were able to deploy capital very quickly. Right. And if you look at the graph of the Quantum Long-Term Value Fund versus the indices, you'll see how we began to outperform the index.
Right.
So it will be a very similar strategy. We're in a similar environment in that sense, where the asset class around which you're launching a product is seeing froth, is seeing a peak environment, as you indicated in terms of valuation. And as you have rightfully said, your client should be careful. Yeah. And our perspective is, yes, give us the capital, we'll deploy it carefully. And as Chirag indicated, a third of the fund, 35%, can be in non-small caps. So we'll be buying mid caps and large caps, which you can deploy. You can still be with the market. And keep in mind that there are many large cap stocks which are still inexpensive. If you look at the quantum long-term value portfolio, it's trading at roughly a 15 to 17% discount to what is the index PE ratio, right? So you can pick up similar stocks from their perspective and put that into the portfolio. You have exposure to the market and you're sitting on cash. And you deploy as the markets correct. We already are seeing some signs of rationality, not from Indian domestic sources, but from what's happening globally with interest rates, right? So that's already bringing money is being converted into capital.
Right.
Money is what you play with, capital is what you price. So when interest rates were zero, people had play money around the world. Interest rates are now nearing 5% in the US, and now you have to start pricing capital and alternative places to deploy your capital. So at some point in time, that will reverberate in India, and we will see a correction in which at that point in time we can deploy our lives. So that's the hope. So it's not that we'll be sitting on cash all through. We can deploy capital, but we'll do it selectively, carefully, and wait for the right moment to deploy fully.
So we will look for margin of safety and we'll prioritize
Yeah, that's in the stock.
Exactly.
So there's two things. One is the way you deploy the portfolio. The other is the kind of stocks you're buying and investing, which was Chirag alluded to earlier.
And Ajit, since you're so passionate about asset allocation, you have spoken about it on so many platforms. So could you also, for the sake of whoever is watching this, where this small cap allocation would fit in, if you can talk a little about that.
So I'll talk within the quantum group of funds because I would like to obviously talk about the quantum allocation, not your funds in other allocations to other funds. So in our opinion, you look at your daily expenditures and you should keep anywhere from 6 to 12 to 18 to 24 to 36 months of your monthly expenditure, into the liquid fund, into the quantum liquid fund. And the rest you can break up between equity and gold. And you can do 90% equity and 10% gold, or 85 equity, 15 gold, whatever suits your purpose in that sense. But you have the calculator on the website for you to make that call. Within equity, we would assume that this should be, as we said at the start, not more than 10 to 15% of your entire equity portfolio. 15 is a bit aggressive, but a little maybe closer to 10. That would be my view. That's what I would do. Right. So when I invest in this fund, or that's what I will be allocating from my side. And I would urge people to recognize that while small caps are volatile, they certainly are, given the fact that they are less liquid and you've got the managements that are less experienced than the larger management companies. So given all that, there will be risk to their business. There could be shocks in the business that the large companies can withstand, the smaller ones cannot. So it's clearly more risky in the SEBI riskometer scheme of things. I think you're a high risk fund, right? And you can't get higher than a small cap fund, maybe venture capital, but not higher than that in the listed space. So clearly you must have a little allocation, but you should have some allocation.
Right. So definitely, as you suggested, small cap is a high risk, high return category, and it deserves some allocation. So for somebody who hasn't had any allocation, they should definitely look at this space. But in these markets, retail investors are already exposed to this space. So what do you think such investors do who already have exposure to the small cap?
So I'll be very biased in my answer, but I'll also state some facts. So since the start of the year, we've had a situation where investors have brought into small cap funds roughly 5, 6, 7,000 crores, 8,000 crores every month. And from large cap funds, there have been redemptions as such. This is the Indian data that we all see. We also saw a little brief snippet the other day that the number of folios in small cap funds is now equal to the number of folios in the large cap funds. So clearly investors are listening to you and me and everyone else, and they're being diversified across asset classes within the mutual fund spectrum. But the other thing, and we spoke about this before, is when investors are selecting the fund, have they made the choice to be in the right fund? Is the fund that they're investing an apple, an orange, or a banana? What were they expecting? What is the outcome? And I think that if you already are invested in small cap funds, I think you should review what you already own and find out if your fund has a very, very excessively diversified portfolio. In the sense, I know that the small cap fund, and Chirag will talk more about this, has a limited number of stocks. But if your fund has got 200 stocks in it, or 150 stocks in it, or 100 stocks in it, find out how many stocks it had 5 years ago. Right? Simple question on Google, you'll get the answer of your fund. If the number of stocks has grown, what it really means is the person took more money from you, could not invest in the track record which he delivered, which made you buy that fund in the first place, and possibly just bought some other stocks because they got the money and they had to deploy it somewhere. So the conviction may not be as strong as the initial smaller pool of capital deployed. And when you're buying, I mean, if you look at the theory of finance, and PhDs have done research on this, there's a certain size at which diversification makes sense,
Right.
and a certain size beyond which you have over diversified. Then you may as well buy, going back to your very first question or the initial question, just buy a passive index.
Right.
Because it's very unlikely that a fund house with 190 stocks or 150 stocks can outperform an index, right? Because you've already got this lack of conviction by having this broad number of stocks, and you're paying a fee. You're paying an active manager management fee. May as well buy a cheaper ETF or index around the small cap. So I would urge you, if you already are invested, and many people I'm sure are invested, they should review what they have and probably take out some of that and think about giving it to Chirag.
Absolutely.
After reading the prospectus and
Yeah.
SID and all that stuff, will
that's
go
very
with it.
important. So if you see, we are in a bull market, right? When the stocks are rising, everything is looking good. Returns are coming, everyone is happy. But these risks only manifest when markets come down, right? The illiquidity risk really increases or becomes many-fold when markets are falling and you're not able to liquidate the positions because there are redemptions coming. You are forced to sell. You're a large owner. You will not be able to liquidate those positions. So overall, we see that problem. And if you think your fund will have that problem because of that over diversification, because of the liquidity, because of being a large owner of that company, then you need to review your portfolio and shift to something that promises to deliver a better outcome to you, a better portfolio to you. So in the quantum small cap fund, we will have size of 40 to 60 stocks at the max. 40 to 50 is the ideal. 60 because there will be some positions that are going in and out. So that could be those positions which could be more than excess of 50, but otherwise it will be capped at 50. So we know the sizing, 2 to 4%. Stocks or portfolio of 25 to 50 is a large range, but 40 to 50 is the ideal number that we think that does not over diversify but gives you adequate diversification and therefore lesser risk to that extent.
And if I can just sort of add a bit to that, many years ago, I used to be the lead manager of what is called the Vanguard International Value Fund, an actively managed fund investing, as the name suggests, around the world in what they call value stocks. And I asked Vanguard as to why they chose the firm I was partnering with as the main manager for that actively managed strategy. And they spoke about the 4 Ps. And they said the 4 Ps of the fund management business is, who are the people behind the investment firm? What is the philosophy of the person or the people who created that investment firm? And the third is, having got a philosophy, so that philosophy could be growth, venture capital, whatever it can be. In our case, it's sort of being sensible long-term investors. What is the processes that have been built to convert that philosophy into the final P, which is a predictable performance, right? So as we've spoken about the small cap fund, when you have a portfolio of concentrated stocks, recognize there's risk and also return opportunity. Because if you're buying 200 stocks, you're like the index, you'll behave like the index. If you're buying 25, 40, 60 stocks, you're more concentrated, and chances are you'll be different from the index. Now, when you say different, it can be different plus or different minus. So that's a warning in some sense, and people should be aware of that. But having said that, we've had a history as a fund house since 2006, and a history as a sponsor since the year 2000 of managing capital, not necessarily small cap funds, but of managing capital. And to go back a long, long time in history, in the days of the Jardine Fleming Fund, when I was the local partner here, for our international fund, we bought stocks that were just listed at that time and were small cap funds, or small cap stocks rather. And in those days, there was no differentiation between large cap stocks and mid cap stocks and small cap stocks within a fund. You could buy them across the fund. There was no delineation as there's today. So as a fund house, we have a lot of history. But also I want to give that warning about the fact that when you take high conviction and a smaller number of stocks and higher percentage, there's a process that we built which hopefully will give us that outperformance of being better than the index in our style, in our approach, than of just being index-like with 200 stocks in your fund.
And also to add that, as size increases, there is a certain market cap and liquidity required at different sizes of capacity, like Ajit spoke
True.
about. So at an opportune capacity which is supportive of current market cap and liquidity, if we reach that size, we'll shut the fund for subscriptions.
Yeah.
It's not that we'll mindlessly continue to gather assets in the fund. We'll be mindful of the capacity that we have based on current market cap and liquidity that we have defined. We will close the fund when it reaches that stage
Right.
for fresh subscription.
As you suggested, we are not asset gatherers, we are asset managers.
Yeah, that's right. I mean, I've written about this thing that when I look at the license, it says Quantum AMC,
Yeah.
asset management company, not
Yes.
Quantum asset gathering company.
Yeah.
Right. So, over the years, with the age of digitization and all the screeners, now every quarter the con calls are happening. So, investors have access to a lot of information that was not possible, let's say, 2 decades ago when annual reports, and that also was not available in the digital format. So, this information asymmetry between experts and, the regular public is coming down. So, and there are a lot of regular investors who actually want to capitalize on this spread of information, this democracy related to it, and are keen on doing it themselves. So, what do you think? What are your views on this? Is it a good way to go about investing in small cap space?
So, yes, I mean, the question, I guess, is should investors directly access
Yeah.
small cap market by subscribing to your research services that you have in Equity Master, which you author, or should they come to Chirag and Quantum and buy our small cap fund or go to other fund houses? I think it depends on the investor's inclination and interest. It takes time to monitor and read all that information. So there's noise and there's information, right? There's a lot of stuff out there. Not all of it is sensible information.
Right.
It's just noise.
Yeah.
So you have to read all this stuff, figure out what's the noise, take that out, then look at the information, assimilate it, decipher it, assess it, and then make a judgment call on what you want to do with services that you offer
Right.
and in Equity Master, etc. So that's up to the investor really. We don't discourage or encourage one or the other. It really depends upon the investor. But like I said, from the start of this year and over the years, we've seen a flow and an appetite in small cap funds.
Right.
So clearly there is a mass of people who don't have the time. They may even have the interest, but not the time to actually monitor their investments in individual stocks. So they're buying a bouquet of mutual funds. Many of them may do it on their own because of the stuff that they read. Many of them may be sold funds by distributors, and some of them may be advised by this new breed of registered investment advisors that has been created over the last few years, where they only charge you fees and there's no commission. So it's really up to the investor on what they want to do.
Yeah.
From our perspective, we are available. It's there. There'll be an NFO. They can buy the fund if they believe that's the best thing to do, or they can come to you and say, Richard, we saw your interview with Ajit and we think Chirag and Ajit are talking nonsense and we love what you do. It's up to them.
Yeah. So I hope
Yeah.
we both are able to offer value. But one thing I would add is that it's true. But that this successful investing does not stop at identifying a good stock.
Correct.
It's all about temperament, and that is where I think people like you can make a lot of difference, because otherwise it's just noise and people can acting on it and invest harming themselves.
And I can also say this, I've seen this from my past experience, working in India and outside India, is that a good research analyst may not always be a good portfolio manager,
Yes.
right? So if they're subscribing to Richa's reports in Equity Master and they're getting a list of 30, 40, 50 stocks, Richa's not giving them weights per se.
Right.
The portfolio judgment is being done by the individual investor.
Right.
Now, they may be smart and they may identify a good analyst like you, subscribe to your service, but they have to build a portfolio construction model around that.
Yeah.
And that could also be a problem, right?
Yeah.
Yes.
So they may have great research from you, great insights, and they'll be very happy to get your stuff and say, fine, I'm going to do it. But the question is, how do they size the portfolio? That itself is an art.
Yeah.
Yeah, so that's a very frequent query that I get, and because we are not advisors, so obviously I refrain from telling them the allocation. So it was very interesting to talk to you. Thank you for having me and agreeing to talk to me at such a short notice. And as Ajit said, it's not just about picking stocks, but also allocation. And, there is somebody who can handhold you through this entire journey. So thank you, viewers, for tuning in. I hope you enjoyed this chat as much as I did. And if you're looking for somebody to handhold you through this journey of small cap investing, you know where to go. Thank you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.